Good afternoon, everyone. It is September 27th, 2020. My name is Faisal. I'm the head equities analyst over at the Alpha Trades. Usually on these Sunday videos, I tag team with Amo and we kind of get through some of the macro news and the factors that are going to affect the stock market. But he's busy traveling right now, so I'm just going to take on this video myself. I know it's kind of sad. I look forward to talking with him, but bear with me here. We're just going to cover a couple of topics today. I'm going to keep it really short. So just to outline some of the external factors that are weighing down on the market, we could talk about how bonds are moving, how the dollar is starting to bounce back from its lows, as well as how COVID is going to play into the market. And I think I'm just going to keep it to those three topics. I'm not going to go too much into uh, individual stocks or what I look forward in the week. If you want to kind of see my analysis on that, go ahead and check out Friday's video. I put out one where I really dove into what happened last week and what the outlook is for this upcoming week. So check that out if you're interested. But anyways, let's go ahead and get to it. So just to start off, I think after this week, what we saw, let's go ahead and go over the indexes real quick just to get a brief overview of what happened. So let's go ahead and check out DIA for the Dow Jones. Okay, so it was down 1.74%. The S&P was pretty much flat, but slightly down. And then I think we'll go ahead and do QQQ for tech. QQQ was up 1.76%. Tech was doing fairly good. And that kind of goes off of the fact that at the beginning of the week, it looked really ugly. And then towards the end of the week, we started to see a lot of high growth stocks, big tech leaders, NVIDIA, Apple, Shopify. They all started to power through around Thursday, Friday. And I guess I'm not surprised to see that tech closed the week positive, where you also saw, I missed IWM, where you also saw IWM close down horribly. And the Dow also closed slightly down. So I'm really not surprised about it, but ultimately I think it bodes well for this week, and I'll talk a little bit about that in regards to how COVID may be sparking this type of tech rally again. So at the beginning of the week, you started to see bailout stocks like Delta Airlines, for instance, is a short that I'm in. You could look at another Southwest, or I'm sorry, United Airlines, Royal Caribbean. A lot of these stocks had terrible, you see the right here, this was a Monday, so a gap down. They had terrible openings on Mondays, and they really started off on the wrong foot. And that was ultimately because COVID cases were actually on the rise in Europe. And just according to the data that I've seen today, it's starting to be on the rise in the US. So you're starting to see a lot more volatility that we saw earlier on when COVID was a little bit more relevant in society, and it wasn't on the downtrend. Now it looks like it's starting to go back on the uptrend. You may start to get this tech rally that we saw before, where the stay-at-home names and the Corona Advantage names will continue to outperform and see extended premiums because they're considered a safe trade. Due to the fact that COVID will continue to restrict things like travel and hospitality and multiple sectors, retail, brick and mortar retail. So the rush to safety and tech may be something that we saw initial signs of this week. And that's basically because you saw high growth stocks, whether it was Shopify, DocuSign, a lot of the winners, even the gaming stocks, they're not, I mean, they are high growth stocks, of course, but, they had better weeks than the market. Let's go ahead and take out Take-Two real quick. Take-Two was up 4.6%. Activision was up a little bit. Let me check EA real quick. Okay, so the majority of the big gaming stocks were doing fairly good, or actually really good this week. And once again, that may go along with the narrative that as COVID starts to pick up, you will see these tech names get that momentum that they got beforehand. The only difference is, they're trading at way more extended premiums, technical levels. So it may not be the same, but once again, I think it's best to assume that you will see them outperform the market as COVID continues to play out. And you probably should not be in any of the bailout names as this COVID thing starts to uptick. just based on how similar the trends are that we're seeing now compared to, earlier 2 months ago, 3 months ago when COVID was more relevant. So yeah, COVID could still play a part on this market, but for those who are thinking that it's going to derail the whole market, I think it's still uncertain because we're trading at far different technical levels, valuations than we were beforehand. So the rush to safety, it comes at a higher price. But ultimately, I think based on what I've seen, that you can assume that tech will continue to outperform, and you can see a scenario where small caps, the Dow, and probably most of the S&P, a lot of definitely the sectors that are the most hit by the coronavirus, you're going to see them underperform significantly, where you'll have the NASDAQ rise 1% and the Dow down 1% or something like that. We've seen that disparity earlier in the year, and it wouldn't be surprising to me if we saw something like that over the next couple weeks. All right, moving on to the next topic. I can't get the dollar on this thing. On my other charts, I could type in DXY and stuff, and it would give me the dollar index, but that's not the case here. So I'm just going to go ahead and use UUP. This is an ETF, a dollar ETF, something that I sometimes use. This is it? Okay. That I use to just watch the dollar. If I'm unable, like if my main technical charts are down, I'll just watch the dollar to do this or something. So as you can see, the dollar was really on a decline, and then started to bottom out, really formed this nice base here, never broke this level, surprisingly. But, looks like it's breaking above some key resistance level. And not only that, but this trend right here, let's see this price right here, that's significant. 25.41, was it above? Oh, dang, so it's handily above 25.41. That's a pretty good sign for me. Oh, wait, let's check this gap real quick. 25.49. Okay, so that is really, so it's above that gap price. That's a very good indication. And not only that, we're seeing volume come in. Once again, this is an ETF. This is not the actual dollar value, but it's a highly traded ETF. So I put some value into it, and you can see the volume starting to rise. It looks like people are getting more bullish on the dollar, and once again, that could weigh somewhat on international companies. And we may have seen something like that this week, where the Dow actually closed down worse than the S&P and the NASDAQ. And let me go ahead and take a look at one of the main sectors that are affected by the rising dollar, or the rising or falling of the dollar, is the industrials. That's what I like to look at, especially the diversified broad industrials. So I'm just going to take a look at XLI, even though it has some domestic industrials like railroads in it. I'm just going to see. So, okay, it actually did kind of good. So let me go ahead and do the individual one. So UNP was up 1.27. 3M was flat. What's another good one? Honeywell. Dang. Okay, so far it's looking good. Maybe the dollar rising is actually not affecting the market as much as I had originally thought going into here. Let me see. What's another good one? Let me see. Caterpillar. No. Okay. I think I've seen enough. Okay. So yeah. So while the dollar rising could still, of course, pose a risk to the markets, it seems like the dollar trading at these levels, and I got to check my actual technical levels. These are not my technical charts, but just to see, I mean, just from a very broad standpoint, it looks like it's going to want to continue to outperform and go up. But it seems like we're still at the point where the dollar is still too low, and it can rise up somewhat and continue to be fine and not weigh negatively on risk assets. So that's something to keep an eye out on. If we start to see big moves in the dollar, I would once again pay attention to those multinational industrials as a barometer in regards to whether or not it's actually affecting the market. So, you could also look at commodities, but ultimately, I usually like to look at how the multinationals are doing, especially since a lot of them are close to 52-week highs, and they've gone up with the market. But I think that's in large part for the dollar selling off, and so once again, if it's been pumped up because the dollar has sold off so much, I think if you start to see it rise significantly, you're going to see stocks like Caterpillar definitely see some pressure. All right, and the last thing we can talk about is bonds. I have not checked out bonds in a little bit. Once again, I just thought as long as they stay somewhere consistent, um, and don't show too much volatility, I think that was the main thing I was looking for, and I've been saying that for the longest time. You know, I don't want to see something like what happened in March. You could see how it kind of basined out, sold off, and then it seemed to have found some type of range between 161 and 172. Now, if it breaks above either of these prices or breaks below, I mean, you could say 153 technically is the low, but I think the that range is kind of wide. I think it'd be wiser to look at 161 or 160 and a half as that range, that bottom end of the range. So it kind of needs to stay within here, and as long as it continues to stay within that range, I think there's not much else I can comment on. I'm not I'm not a bond expert, I'm not a treasury expert, but I understand that volatility comes when these types of assets break their norms. And so for my job, at least from a stock guy, is just to understand where the norms are and where they are established, so that I know when they start to break them, that's when it's time to take risk off the table. And then let me take a look at LQD. You know, let's see what the Fed has been doing. All right, so everything is looking good. Oh, that's interesting. Let me see this low, 134.56. So it actually broke through. Very interesting. Um, 134 and a half, 130. I'm going to go ahead and say this is a really interesting thing, because LQD is obviously, when we think about the Fed buying bonds, they're buying these investment grade bonds. They're buying the good bonds, you know, the Microsoft bonds, the Apple bonds, even though they don't need it. That's just what the Fed has decided to do. And LQD has largely benefited from that buying process. As you can see, this ETF, you know, it's an ETF. Keep in mind, it's not an actual, you know, it's nothing more than an ETF of and a technical indicator of investment grade bonds, in my opinion. But you can see how it's really outperformed. I'm sure it's relative norm. I haven't done the back study on that, so I can't give you a precise analysis, but it looks like it's really increased its uptick in volatility, gone very well with the market, but looks like it's really started to break down. And I don't know if it's because they're waiting for the Fed to purchase more of these bonds, but that's a very interesting thing. And I have nothing to say on it right now, but I think as long as it stays below 134 and a half, that's a pretty key level. I think that's a level that we should not be trading below for an extended period of time. Like I would expect a bounce to come sometime soon, and also a discontinuation of this downtrend. It seems like this right here from 139 came up a little bit down, tried to basin out, and now it looks like it's starting to head back for another leg down. The volume is starting to get fairly high and negative, and so this is definitely on my watch list. You know, I wasn't really looking at these things before this video, and so, you know, just looking at it now, I definitely think this is going to be on my radar for the week. Once again, I can only read it so much. I'm not a bond expert. I can only just establish the norms and some of the trends, and hope I can get my read right from there. But once again, I don't want anyone to take my advice too seriously, because I'm not a bond guy by any means. But definitely on my radar, as long as it continues to stay below that key level. All right, and so that's all there is for today. I hope you guys enjoyed it. Once again, none of this was financial advice. This is all, you know, my own opinions and just my own take on the market. You guys can see clearly how I think. I do this pretty much off the cusp. I don't really prepare for this, so you know, I want you guys to understand my thought process, and you know, when I look at things, I like to talk to them about it, and maybe you guys agree with that process, or you know, if you leave a comment down below of how you guys may see certain things like LQD or TLT, I'm all for hearing y'all's opinions. So anyways, take care. I hope you guys enjoyed this video, and I'll see y'all next time. Peace.